Like a lot of people in this industry, I started working in gold and silver after the 2008 crisis, of course, when gold was heading to an all-time high. And we were trained by the companies with the best resources. So obviously those companies had money to spend on training. They did a great job. We became sort of, expert in this field for sure. But what we started to realize over time is that our clients' accounts just, it was just a huge gap for them to close to get into profit or to not be down on the investment. And the really heartbreaking thing, of course, is if they needed the money sooner than they thought, they really were taking a big hit, and we couldn't figure out why. And over time, and you see enough clients, that happens to, you start to do the numbers and starting to figure out that the numbers that you're given initially from those companies don't exactly add up. You confront those companies about it and ask that question. They say, well, what do you think pays for those $30,000 ads on Fox News or Bloomberg or wherever? I mean, that's how much those ads actually cost, $30,000 a pop. And some, companies are running 10 to 20 ads a day. So I see the point, but the problem is it just doesn't work for the client. There's too big of a gap for them to cover in order to get to profit, and it's just a losing investment. And for people like me and the people who work with me, it's just not a business that I could continue to do. So this company has really been an experiment. We started with the question, what is fair for the client? So we decided that transparency as to what we buy the coins for and what they're buying them for is offered. And we have a margin of 5 to 20% max. Now that 20% is about half or even 1/3 of the cost that you'd pay for the same coins with the other groups that charge higher margins. So what you can get with us is the coins that you want at a price that is totally reasonable. It's actually more competitive with the online discount bullion houses where you get no service at all. Of course, we have a whole back end IRA services. We can also walk you through the reporting benefit involved with a retirement account to where that almost negates the entire 20% margin if you decide to do those coins for an IRA. So the first step was what's fair for the client. And from there, I had to decide, can I pay our account executives the same money they were making at the other firms? And it turns out that if I keep my overhead low, I can. So what I'm able to do at the Bridgehampton is have the top level talent from the industry at the very best pricing you're going to get from a full service firm. And to me, that's the best value that you're going to find. The best thing to do is to contact one of our senior account executives. We've all been doing this for over 10 years. The truth is most IRAs are eligible. 401ks are eligible after a certain age. But with the Help and CARES Act, you're actually able to move those now. When it comes to an annuity, that's the really interesting one right now because we as Americans are sort of trained to think of annuities as the safest possible investment. But the truth is that in times of inflation, it's not safe at all because it's a fixed income investment. So if you have $6,000 coming out per month, but then we print all this money and now it only buys $3,000 worth of goods and services, then your quality of life just went down by 50%. What's interesting about the annuity companies is that the personnel there are actually trained to mislead you as to the cost of exit. Oftentimes, our clients will call them and be left with the impression that it's going to cost them 20% of the value of the account to move. In reality, it's sometimes less than $500 or sometimes less than $100 to get out of the account. If there is a large surrender charge, there are certain circumstances where we can significantly help the client to lower that cost. So once again, I suggest that if you have an IRA, 401k, annuity, or any kind of product like that, even a pension, and you'd like physical gold and silver to be in your portfolio, that you simply give us a call and talk to one of our senior account executives. Because we have history, right? If you're a student of history, then you have a pretty good idea of what's about to happen to the gold price. The previous high was in 1980, then 2008 happened. Now remember, we had one of the strongest economies ever going into 2008. We decided as a nation to print money to bail out those banks and those insurance companies. And then we all know what happened to college tuition. It went from $15,000 a year up to $75,000 a year or whatever it is now. But the interesting thing is it's very similar to now. Gold, 4 months into that crisis, was at about $850, technically an all-time high in gold. So should you have bought it then? Yeah, it went up 125% from there. Gold doesn't change in value. It's just a measure of the value of the currency that it's stored in. If you run the printing press and you devalue our currency, the gold price goes up as a result. If you go and look at a chart of the gold price versus the dollar, it's really like a mirror image of each other. Gold being at an all-time high doesn't really matter. I mean, the thing that is most important is that this time around, we started at about 1750 when the crisis hit. The economy is in much worse shape than we were in 2008, and they're printing money at just an enormous rate, much, much higher than what we did in 2008. So in my mind, 125% increase puts you at 4,000. I think you'd be crazy not to get your hands on whatever gold and silver you can right now, especially because there's a shortage. Premiums are going up. It's harder and harder for us to find the products that our clients want. So if you do want to get involved, we suggest that you give us a call as soon as possible. Right now, the US government, they're printing every 2.5 weeks the equivalent of the entire response to the 2008 crisis. So every 2.5 weeks, we print that same amount of money that caused gold to go up to $1,900 from $800, to go up 125%. So you could make the argument with the money printing, every month we're doubling up the amount of money that's in circulation. You could make the argument that we could go well above 4,000, but remember this, and I think this is the most important thing for anyone who's on the fence. So in 2008, that money was used to buy bonds, it was sent to banks, and it was sterilized, is what they called it, meaning that there was not the velocity of money. The money went to the banks and stayed there. It was not pushed out into the general population. This time around, they are actually sending money out to the population and people can spend it on whatever they want. I would say with the amount of money being printed and the velocity of money, you're looking at inflation that we haven't seen in our lifetimes, maybe since the late 70s. It's just extraordinary circumstances, and I'm very concerned about our clients losing their purchasing power before they convert into gold. I buy it because it's a no-brainer. I didn't understand this before I was in the industry, so I don't blame anyone who doesn't understand it now. When you're increasing the money supply as quickly as the government's doing right now, I understand that that's what they feel they have to do, and I'm not saying that they're doing the wrong thing, but it's just a simple understanding of when you increase the money supply, inflation happens and gold goes up in value. Not because gold changes in value itself, it's just that more dollars are needed to buy the same piece of gold. Does that make sense? And the other thing is that the stock market is just it's just so risky. I'd much rather have my assets in a gold and silver, which have never gone to zero, and have a 100 to 200 to 300% upside potential right now, versus the stock market, which I think maybe has 10% upside or 20 and maybe 50 to 70% downside. If you're in an annuity while they're printing this much money, you're in a position to take a major hit on your quality of life. My two biggest concerns are, one, are the bankruptcies, just because every bankruptcy is a huge bank loan that doesn't get paid back. And you get enough of those, you're going to have banks that are going to be in major financial distress. I'm also worried that we could potentially lose the world reserve currency. The dollar is the world reserve currency, because when we print all this money, anyone who's holding dollars, is losing. I've noticed recently in the media that switching off of the dollar as the world reserve currency has now become a topic. Like an actual topic that people are talking about on television as if it's possible or could happen soon. And so Sam Zell, who's a billionaire investor, and he came from another country, so he understands currency risk. He's an immigrant. He had said that if the dollar gets replaced as a world reserve currency, our quality of life in the United States will go down by 25% overnight. And so that scares me, because if I have clients who haven't gotten started yet, or haven't got their 10 or 20 or 30% gold and silver, then their quality of life is going to take a hit. And that's what we're here to protect. In 2008, that was an extreme response, but what's happening now is a Frankenstein monster compared to that. You're talking about printing the entire response to QE 1, 2, and 3 every 2.5 weeks, almost doubling that every month. And we've done that for 4 months, and there's no end in sight. And schools aren't going to reopen. It looks like the economy's not really going to reopen. I just don't see the daylight. And so my concern is that there's going to be some kind of a major shift, like a dollar restructuring, or something along those lines. That's my biggest concern. A banking failure or a banking meltdown, and the dollar being lost as a world reserve currency. Those are my two biggest concerns going forward.